I'm Roger Brooks. I'm the founder, creator of RBrooks Group, a retained search firm based out of Boulder. And want to be able to introduce our panel, but I want our panel to also introduce themselves. But I also want to tell a little bit of a story about them, so you get some additional color. Sandrine, I'm just getting to know. We just met at this conference, and she's an investment banker. She's got all the knowledge base around what a company needs to have pulled together to be able to help them raise capital. So she's a great observer of companies and what they need to be able to go to the next level. Dave Marver and I got to know each other a few years back on a CEO search. I'm the person that pulled him into a company that at the time was called GTX Medical, now called ONWARD. Dave, he probably won't say this about himself, so I'll say it for him, Dave. Hopefully you don't get upset with me. He's done something that's quite remarkable. When you look at impact CEOs have on organizations, this one you can look at numerically, and the needle that he moved. When he joined the company, they were probably at I might get my numbers wrong, but they had a pre-money valuation where investors are providing term sheets that probably are around the mid-30s. But there's $85 million invested in the company. And so the investors ended up making a change, and Dave comes aboard. Essentially, the company didn't even change much. It's really the same product, and Dave kind of rethought the strategy around the company, the markets, and most of all, figured out how to tell the story so an investor could see it. They can now visualize it. And he took that company that was struggling at a $35 million to do what some think was the largest IPO in medtech history on the Euronext, and had a pre of about $350 million or so, and he raised $100 million by going public, which would be a great question we'll get to. Why on earth would you do an IPO when you don't have revenue yet? So he'll address that one. And then we have Aidan. We'll call him hot on the scene with one of the most remarkable capital raises that's catching everybody's attention, pulling in a $100 million tranched investment from not from your unsophisticated investors. His investor syndicate, some of the most sophisticated, experienced groups out there. So hats off to him. I can't wait to hear how he did that, but it's really neat to see. So why don't we go down the line, give your own introduction of yourself and a bit about maybe the capital you've raised or things like that, a little bit of history.
Yeah. So hi, Sandrine Cailleteau. So I'm responsible for covering European medtech and diagnostic companies. My background is the industry, where I worked for 20 years in various M&A and business development licensing roles. So I've also been in your shoes, trying to raise funds for a listed AIM company just before the Lehman crisis. So that was quite an endeavor. And I've been on the advisory side now for almost 15 years, with RBC for 2 years. And so I've helped a number of companies with their Series B, Series C financing, crossover financing, and going to the US. And where I put all my effort is, in bringing US investors on board for European companies to help them gain not only money but also expertise and connection into the US, and also supporting companies then with their M&A needs. So I see this as a partnership, and nothing makes me happier to help innovative companies succeed and see their progress.
Well, thank you, and thanks, Roger, for the opportunity to join this panel today. I'm a U.S. and EU citizen, born and raised in America, actually in Ohio, where they eat dogs and cats, I've come to learn. I've spent my whole career in med tech, so the first half was spent with Medtronic, and that was my first opportunity to come live and work in Europe, in Switzerland, and I fell in love with the opportunity to live here. In addition to working for a big company like Medtronic, where I had vice president roles in sales, marketing, strategy, corporate development, I've also founded 2 startups. I love to create cultures where there's a lot of innovation. So I have 3 Time Magazine Best Inventions. I'm hoping to add to that shortly. And then while CEO of ONWARD, I've raised capital via a convertible note, an IPO, a follow-on financing, and also a debt financing. So you do what it takes, right? So I have a broad range of experience that way.
Good.
Hi, and I'm Aidan Crawley, the founder of Amber Therapeutics. I guess I made the mad move to come from tech to medtech. So maybe it's because I didn't know any better as the sort of route of managing to get this Series A done. But I think kind of my background was traditional sort of software, and I was actually in fintech. And the opportunity to work with the co-founders that I'm now working with on the Amber opportunity was just so irresistible. And I think that is the underlying basis for why we got this fundraising. Like, for me to move from where I was to want to do this and try and beat all the difficulty with regulatory risk, clinical risk, the amount of capital you need to raise, the time it takes, the problems with valuation, and being a first-time kind of medtech CEO, all of that is worth it if the underlying value proposition of what you're doing is just so clearly transformational. And so I guess my biggest insight with a fundraise is if you're having to if you have a story which is why you joined or started something, and you have to then create a story for investors, there's already a problem. If the story that you joined is the reason and the one that you sell to investors, at least you're onto something from that starting point. And so I guess that's my introduction.
Okay. Thank you. And so our official title to our panel is The Current State and Insights from Successful Raises. What we kind of think of as really a broad topic. And so we want to go all over the place. But let's start with that, the current state of affairs. How everybody's feeling about our current fundraising environment, where the hot pockets are, where the challenges are, and how do you see things playing out here the next year or so. So maybe we go the same order and share that.
Yeah. So clearly, we see this year some improvement in the financing environment. In terms of total raise this year, we are higher at this stage as we were last year. So that's a slight improvement. I think in terms of valuation, it still remains soft, or with about 30% of all the raise, both in Europe actually and in the US, being down or flat rates, and the medium increase in valuation is only 1.1. So quite limited. But what is interesting, there's lots of money and dry powder available, lots of new funds that have been raised, and different profiles of funds. So there are growth equity investors, structured funds. So I think this creates lots of opportunities, as you could yourself benefit. A lot of new debt funds, not just the traditional debt venture funds. So clearly a more positive environment.
So you're optimistic.
So more optimistic. There's been also an increase in M&A, so that's obviously also critical for investors. So it's still difficult.
Yeah.
I think for the IPO market, we still see this at the moment pretty closed, and most of the transaction targeted now towards 25. But the mood is certainly shifting, and very interested in hearing your views, and also size of the rounds, because clearly it's interesting to see recently a lot of sizable rounds, and clearly for investors it's important to see that companies are well funded. So
good. So Dave, your story is a little more complex because you're already public, and so you have to tap different places, I imagine. So tell us about what you're experiencing out there, and who's responsive, and is it good or bad, or?
I mean, it's all nice to put guys up here that have raised $100 million. It makes it look easy. I mean, I can tell you that anybody with a pre-revenue medtech company, it is hard, and it has been hard for 2 to 3 years. And I think if you're one of those CEOs and you're in the audience, it is stressful, and you lose sleep because you're responsible for the welfare of your team, and and for coming through for your investors, as well as just fulfilling your mission to help people. So it's a tremendous stress and burden if you're a CEO of a pre-revenue medtech right now. And I think to paint it any other way would be, I think, unfair and inaccurate.
Yeah, well, and to build on that, I've been coming to these conferences, different variations of them for a long time. It's always been hard.
Yeah.
There's always a reason not to invest and why it's doomsday or something negative. But I'm incredibly optimistic. Of course, I mainly speak to people who have already raised a bunch of money.
Yeah.
But I think we're in a nice, steady climate.
It's getting better, but you still have to turn over every rock. You've got to find capital wherever you can, whether it's family offices, high net worths, venture clubs that aggregate individual or retail investors, corporates, like whatever it takes, you have got to do it. That's the environment.
Investors want you to be innovative while at the same time, have validated business model.
I know.
Clear commercial path.
And so, Aidan, it looked, you read the press and it's like, looks pretty simple. I think Aidan turned over 4 rocks, or 5? 5 rocks. He turned over 5 rocks and he picked up $100 million of committed capital. It looks easy. Tell us a little bit about what you sensed out there from the environment.
So I agree with Dave. I think it's really hard, particularly the last 3 years or since I've kind of come into the space. I think one of the elements that is hard is the process itself. As you were saying, for early stage companies to need 10-year validated business models with route to markets and every layer of due diligence being overturned, even in a process which all the investors want to invest, it's still 7 months. So I think there's an element that even when you have the interest, converting interest to capital in the bank has never been harder. And actually, from my old tech days, you had a sniff of interest and it meant you had capital. Here, you have to temper every good meeting you have. Even the 15th one, it's still just nothing until you get a term sheet. And even when you get a term sheet, it's not committal until you've closed the deal. So I think there's an element that the hardness isn't just the attracting of capital, because there's loads of capital out there. It's about the converting interest to capital in the bank. That's one element that's got harder.
Say that again.
Converting interest in your idea to money in the bank and actually getting through that process. That's what, for me, has got harder in the last 3 years. People will always take a first meeting, even in a bad market. The only positive spin I would have is that I believe that the hardest markets are actually often the best for the companies with the best value propositions. So in a good market where it's plenty of noise and tons of capital and everyone's getting invested in, often the concentration of great companies is diluted a bit and investing money flies everywhere. I personally put a lot of the reason that we got such a big round from such great investors was nothing to do with my ingenuity. It's more funds recognized our value prop and they all wanted in because there wasn't that many other things that they had that level of conviction about. So I actually think that the size of the round we raised was in part due to the hardness of the market for us. But that's why you have to have conviction in what your value prop is. If you're half-hearted about what you're doing and the value that it presents to investors, it's going to be a very hard market. If you really believe in it, then it's out there.
So how did you figure out who to approach? Did you approach everybody, or did you have a system? What was your system or process, and what advice would you have for others about developing a system and process around who to approach? And then we can talk about how to approach them second. But how do you figure out who to approach?
Well, again, Dave and I would share different things because in public markets, I think the strategy is different from very early stage. Early stage, it's the founding story, and it is us. There's no kind of third parties. I would always say it has to be a warm intro. Every intro has to come, even if it's not your direct relationship. You know it in every aspect of life. Like if someone you really trust is introducing you to someone else in terms of a partner in a fund, that meeting already has a pre-meeting associated with it because of the connection that those two people have. So, we could have met the same fund through different means and had a radically different entry point that would have made it a much more uphill struggle to get to the right connectum. So I would say always warm intro. And then, if all intros being equal, there are just certain funds that fit the profile of what you're doing better than others. Yeah. And I think really early on, distinguishing between who is a proper lead investor who will go out on a limb, even if others aren't interested, and lead, versus who are co-investors that are people, even with tons of capital, that will basically wait to see a lead in place before they jump in. And then you have the whole question of the strategic. And if you want to play that or not, in terms of if and when, at what stage in your business, again, for Dave, probably strategics are always part of it. Early on, it's not always completely clear whether you want strategic interest.
How did you get that information? You're going to their websites, using intuition, you got a database?
No, it's all network. Like, it's,
Okay.
I mean, we're not a
Your
big
network
community.
is giving you your answers.
Yeah, and I didn't have a medtech network, but it's not. I mean, there's not a big community. Even coming to LSI, 2 or 3 times, there is a handful of. Medtech isn't that sexy in terms of, in comparative to technology. There are a few really blue chip funds in the US and Europe that still have a very interested and a great track record in medtech, and in our case, medical devices, and is a handful.
Yeah. Well, so before we leave Aidan once, he says it was his story was compelling and easy in a way, but there are a lot of companies that saw what happened with Axonics and are entering that space, and so the competition and for the capital, I think, was probably fairly competitive. But Aidan's got this laser focus that he blocked out all the competition, all the other people knocking on the door because he knew he had something. I imagine that's what happened, but it's crowded out there.
Yeah, but when you say it's crowded, it's like, it might be a crowded space, but it might not be a crowded value proposition. I don't think that was, for me, the issue was more, I have the best founding team in the world, most experienced, in terms of engineering and clinical expertise, the best innovators in the world to deliver on our, what I would call transformational therapy proposition and the technology, to deliver that. I think the hard bit for me was the story, if it works, sells itself. The hard bit is you need to navigate around the skepticism in the market. So whether it's my experience, whether it is, there's no skepticism around the size of the market opportunity. There's no skepticism around the lack of a perfect solution today. And neuromodulation has been established in the space for 20 years. So in that side, those are not uphill battles. And I felt that the skepticism is, why can you do this and no one else has done this before in terms of our nerve target? How do you have the experience to navigate yourselves through this very complex challenge of taking a regulated product to market when you haven't done it before? These are difficult challenges, and that's where you invest your energy. But the story, the reason I hopped from tech to medtech, as I said earlier, is that was not the difficult bit. It was the execution of it that I think was the bit that needed a really convincing narrative backed up by your team and talent.
Yeah. So Dave, hit me with how you figured out how to tell your story. Tell us that whole process.
Well, I actually think most of it is relatively formulaic. Investors, whether they know it or not, do have a checklist. Sandrine referred to it a couple of times thus far. They're assessing the strength of the management team, the technology differentiation, the strength of the intellectual property, the maturity and compelling nature of the clinical data. In many cases, I think European companies suffer from a great deal of scrutiny and skepticism around that entity's ability to commercialize successfully in the US, especially if going against large entrenched competitors. So all of these things are boxes that need to be checked. But what Aidan said is, I think, also really important, especially in life sciences, is telling your story with emotion and impact, because investors are people too. And I think those that self-select into life sciences want to make a difference, want to make an impact. And also, they have to sell to their LPs. They have to bring interesting stories about their portfolio companies, their activities and returns to their LPs. So this is where the ability of a founder to convey in a succinct and focused way passion, enthusiasm, impact really matters. Communication, in my experience, and the bankers tell me this quite a bit actually, is especially in Europe, the founders tend to be quite technical, and they cannot stop themselves from explaining their widget in great minutia. And this becomes a problem. And they really have to be disciplined.
Yeah.
And you had quite impactful press in the, on the BBC, in the Times, and other, European papers.
Yeah, in our case, that's very intentional. When I got to the company, the marketing guy, he was paying for advertorials, which I think was silly. We have something that's really understandable and accessible and powerful. So I do intentionally use earned media wherever possible to raise awareness, and it does resonate with the investor community also.
Yeah.
But not every company can do that.
So if the audience isn't tracking ONWARD, You can do it on their website. You can somehow get access to the incredible amount of free publicity they get out there on all these stories that generate a lot of interest. And of course, being on the cover of Nature magazine 3 times.
Well, there have been multiple Nature publications. I mean, that's the scientific foundation.
Yeah.
I mean, that's critical. But being a listed company, and I think I skipped over your question, we listed because it was the one place we could go to raise 85 million euros and provide 3 years of runway at a time when we needed the capital, okay? And for a lot of companies, it's not ideal. On Euronext in particular, there's low trading volume. It can be difficult for people to get in and out of the stock. So one of my jobs then is to maintain interest and trading volume in the stock by using earned media. So it's just part of the toolkit that a private company doesn't necessarily need to exploit, but for me, I think it's very important and valuable.
And was it there wasn't an appetite from any private investors to invest $80 million into ONWARD at that
I
change?
didn't have time. So to Aidan's point, the VCs in the U.S., and particularly in the U.S., that could write large tickets needed time. I had to raise the capital quickly. I got here, there wasn't a lot of capital. I did a quick convertible note, and then boom, right onto Euronext. Okay? And now I'm managing the best I can on Euronext. Not so bad, really.
Yeah.
And I'm comfortable running a public company because I'd done it on NASDAQ before. But it would be, I think, challenging for a first-time CEO.
Your IPO was really unique and circumstantial. Okay. Well, and let's bridge it to the story of how, if somebody wants to think about the public markets eventually. Even Shockwave went public. They made a lot of progress first. But what do the investment bankers want to hear? And so that'll be for both of you about.
Well, I think Sandrine can start. She does.
Yeah.
This is her day job. And then I'll
How do you?
News flow.
Say again?
News flow is something you want, so regular, news, and I think sometimes that's one of the challenges. As company raise a lot of amount of money, and then it takes time before next milestone. So news flow is important, with obviously all the challenges from technologies, ups and down, and then clearly time to market, and I think that's also an important point because company going public early when time to market is still far creates its own difficulties, and I think once being listed, then it's a new or being commercial. It's a new series of difficulties because then investor will want you to be profitable, and when you're still innovative, so it's.
So in my view, there's Euronext and there's NASDAQ,
Yes.
right? And I think NASDAQ is a market that responds more readily to progress, that reflects a company's intrinsic valuation more accurately. There has not been a medtech IPO on NASDAQ in over 30 months, so it is indeed closed. Yeah. There should be 1 or 2 this fall, but they're bulletproof. They have 50 million in revenue, predictable growth, et cetera. So if one contemplates listing on NASDAQ, you really should have 30 to 50 million in revenue and a line of sight to 100 million within 2 years, and then steady and predictable growth. Yeah. If you look at the companies that have listed on NASDAQ in the last 5 years, the vast majority of them have lost 90% of their value or more because they don't have that. So you should not rush to NASDAQ. And then if you consider Euronext, it is a place to raise money. You do have to deal with the lack of liquidity. In many ways, it's easier to deal with ECM investors than 4 or 5 VCs on your board, by the way, because everyone has access to the same information and you don't have to do anything bespoke for anybody. But you really have to simplify your message because these VCs, they have very smart people who specialize in medtech, whereas most of the public company investors in Europe don't have medtech specialists. They either know biotech or they're generalists. So that's where, as CEO, you have to, one more time, refine your message, make sure it's simple and resonates.
Which is a good discipline because it means you're probably better with your end patients and your end. If you can refine that message, it works for both your investors and for the people you're trying to
I think so as well.
Yeah, and then you need to go back on a regular basis to the market to create liquidity and hence
Yeah, in my experience, if you do a good IPO, you can select your investors. Okay, you allocate, and ideally you pick those that have a long-term view.
Yeah.
And if they have a long-term view, they understand an early-stage company has some ups and downs, might miss some dates, but they're going to hang with you. So I get very few calls from investors saying, "What's going on, Dave?" They get it. And we try to proactively communicate, but not overdo it. So it's a lot less burdensome than you might think.
What do you mean you get to pick your investors when you did your IPO? How does that process work?
It's called a book build. Okay, so first you do a series of meetings where you test the waters, you make sure that there's demand, okay? But then you do a proper roadshow, and at the completion of the roadshow, the funds essentially put in orders. They say, okay, I'll put in 2 million or 5 million at this price. And another firm will say, I'll put in 5 million at another price. And you wind up with a book of demand. That's why you hear sometimes, oh, we're 2 times oversubscribed. Because you might want to raise 100, but you have 200 million in demand. And at that time, that's when you can allocate where your shares go. And you can pick pedigreed, responsible, long-term investors.
Yeah.
And you want to create some rarity, so that those who are not fully allocated still want to buy shares. And you also need to have some short-term ones who can sell so that there is activity on the shares. So it's
Fascinating. So, Sandrine, you get to hear a lot of medtech companies give their pitch. When you think about all the presentations you've heard, what do you find is really missing? Like, what kind of advice would you have for people out raising money on how to properly tell their story in a way that will resonate?
I think it's, the CEO is super important because in the end, the investors will invest in a CEO. So definitely that's critical in terms of story. I think, as you were saying, Aidan, it's have a good value proposition, clear execution plan because it's all about managing the risk for investors, and also be rightly saved. Right size, because so that when investors come in, they have a clear view of what's the exit for them, and they come usually to invest for a 3-4 year time period, and so what's the exit event for them, or what's the next round that will happen, and very often young companies haven't mapped that yet out, or they are also very cautious in terms of size, and I think, Aidan, that's quite interesting. We were discussing, about the size of the round, and you were saying I took, as much as you could, and often I see CEOs saying, "Oh, but I don't want to be diluted, so I'm just starting with this amount."
But medtech's different like that. I mean, in the old tech model, you wouldn't want to take loads of money because you had the potential 2 years later to raise at 1,000 times what you just raised at. So you would almost risk taking less capital to be less diluted to go up. My view on medtech, for all the reasons most people are aware of, your kind of upside is capped a little bit. And so actually the value of maximum amount of money today to get to the next juncture is sort of more valuable than any other metric in some ways. It's very hard to go, you're not going to have viral growth at an early stage medtech company. And actually there's more propensity as time goes on for things to go wrong. So I think raising the maximum amount of money, giving yourself the maximum buffer to get to the next point. And I should contextualize, like $100 million is a lot. It would still be one of the cheapest capital raises to get to FDA approval ever. So it's a lot of money, but and we're raising that to get as close as we can to FDA approval. But if you even put it in the context of how much capital it takes companies to get to FDA approval with a core therapy, it would still be relatively small. And that's the funny bit. It sort of raises eyebrows because it's a lot of money, but it would still be a very efficient capital allocation to get to that juncture. So fingers crossed. But
So, Aidan, are you helping investors think through the idea that if to kind of rephrase it, if you run a clinical trial and the results are what you expect, you would have a valuation of this amount of money. And so because they're trying to get a 2x, 3x, 5x on their early money, you really don't want to take too much. You want to get enough so that they get a nice return at that next pivot.
Yeah, and
right?
I'd be fair. I think the investors are telling me that as much as me telling them that. To be fair, it's not. I think they have the return on capital that they need. Again, it is very different to other sectors because of the amount of capital and time needed, and the fact that, as I said, you don't have many Facebook-like growth stories in medtech. Like to get to $1 billion valuation is a great achievement. You don't go from 100 million to 100 billion in a medtech. So it's that basis where you do have a sort of fairly formulaic return profile, and the main impetus is not to have to raise down rounds and not to have to raise sideways rounds, and to be efficient and to go to market as few times as you can, because obviously that's more dilutive.
Yeah.
Well, one of the things I think about with you, Aidan, is how much time and effort and thought did it take to figure out your tranches? So to be able to work with the investors so that what do you call them, milestones? You have to set certain milestones to get to the next tranche,
Honestly,
I'm assuming?
it's very
How do you figure that out?
It was very straightforward in the sense that for us to get to FDA approval, there are literally two things that we need to do in terms of a European feasibility study to prove out the modifications we've done to our device since the first in human. That's a milestone. And then getting FDA approval to do our pivotal trial in the US is the next milestone. So actually, that, negotiating around the quantums, how much buffer, how to get there, that does require some nuance, but actually, they're very supportive investors, and I think it's not that these tranches are like stretch goals. These tranches are like more just protecting their capital, so like, let's just make sure you get to the next gate before we give you the next batch, and we get to have the interest on the money before we hand it over.
Yeah.
That's more the way it works.
Gotcha. Dave, any comments on that?
Congratulations, this is great. And I just hope it resonates. Here we're talking about, we don't want to take too much money. And the reality is that most people at this conference are really scraping to get any capital right now, and we need to be cognizant of that and sensitive to that.
And you could have 3 great rounds, and it's all going well, and then something goes sideways, and it's the sideways round that wipes everything out. So being less greedy, taking more, building buffer, you might feel like it's chipping away at whatever you have, but if you can preserve that story and not have the side and the down rounds, you will do better, and you keep the integrity of the story intact. And so I do think it's worth it.
Why doesn't everybody do that? It seems to make a lot of sense. You've got your group of investors. They believe in you. They believe in the company.
Tranching is common.
It's definitely more
all the
common
way
in
through.
medtech.
Tranching is common.
Yeah.
Okay.
Yeah.
There are negatives for tranching as well. If it's not clear the next gates, if you do think you have an event that could massively increase your value, tranching becomes a bit of a container on valuation, and it's never as straightforward as I've said. Like, what if we run over a time period for a tranche? But it was the right mechanic for this deal and the stage that we're at.
Okay. And maybe you can all comment on this, is about the different investor types and their different roles of figuring out who's going to be a lead investor, what does that mean versus co-investors, and how do you size up when you're raising money, who plays which role?
I'm interested, Dave, what have you done with strategics over the years?
Well,
Yeah.
I think if you maintain relationships with strategics, and there has to be a good fit, right? And I think the real calculus when it comes to strategics is, what do they want in exchange for their investment? Is it purely a financial investment for them, or do they want rights? And are those rights going to inhibit your freedom to shape the business you want, or pursue the exit that is optimal? So that's the calculus.
Yeah.
Taking on strategic money is a very good thing. The financial investors love it. They tend to be less valuation sensitive as well.
Do you have a strategic
But there's
yet?
a cost. Do I?
Yeah.
I don't in this company have
Not on
one.
your cap table.
No. I have, I think, a better version of a strategic, and that is the Christopher Reeve Foundation. This is their first ever investment in a for-profit company.
Okay.
So, but I met with strategics at this conference. I think that's just good, sort of good CEOing to make sure that those businesses are aware of you, to make sure that bankers, who are like the pollinators, are in the C-suites talking about you and your prospects. I think all of that is smart. You always want to cultivate the fields and make sure that there are as many possible investor types as you can garner. And we haven't talked about family offices and ultra high net worths either, which is, I think, also a place to go if you're not getting any traction with the large VCs.
Joe, I was just speaking with a venture investor earlier today about family office money, and one of the things this conference, I think about how many amazing companies are here. Not everybody's going to get funded. A lot of these great ideas might just disappear because of lack of funding. But the more we can get, I think a family office is really good at that seed stage. The more family office money we can get involved in our industry, the more we can get these companies to play out at least some early clinical that will allow all the institutional investors to come in.
I disagree a little bit. I think that let's say accredited investors or wealthy individuals play in the seed stage, but you increasingly see ultra high net worths and family offices at every stage. And they don't lead typically, but they will follow, for example, one of Aidan's investors, because they'll draft behind that extensive diligence.
They could be so helpful. I think, and also I think that there's a distinction. High net worths, particularly if they're relevant, they're almost more powerful than a board member in terms of how they can help you if they put significant capital in. And I think the family offices often are very large, and where they can help is sometimes they invest more mission-driven. They can be very passionate about a space and care about that as much as their return. And again, that's why, to Dave's point, they don't often lead, but having that type of patient, mission-driven capital can be a really nice asset to have in a mix. But I think you always want a reputable, almost venture lead sometimes to be the one, because that tells everyone in the market this has been vetted by the best. And my final part on the strategics is I totally agree with you, Dave, but I think the strategics are getting better in trying to distance their core business from their venture arm. It's never perfect, because if one strategic's in your business, the rest of the market's going to think you're with them. But they're very good at actually trying to put in the right walls in place and make sure we're looking at this, obviously not totally independently, because they will have an interest with their main business. But I think it's more a nuance of when and how to bring them in. And you always want to keep every strategic up to speed with your narrative. And I think you can do that without them having to be necessarily invested.
Yeah.
And it's
Well, Sandrine, why don't you build on that, especially around the strategics? When do you want to get the strategic involved, and then also follow it up with the family offices? How do you, if you're a CEO looking to pull in some family office money, how do you find it? Where do you go?
Maybe on the strategics, I fully agree. It's important to talk to them early on, because all the venture funds talk to the strategics. So they want to be sure there is appetite from strategics to invest in companies. So indeed, it's important to speak to them from the beginning. And also, having worked a lot in business development, strategics also, for them, there are some important milestones or steps, things to do. And so I think it's also a good learning for CEOs to understand where they should also focus their efforts, questions that they will have to address as they grow. With family offices, maybe one of the challenges also to manage valuation, because sometimes high net worth invest in companies and they have a sense of the value of the company, and you need to navigate and make sure the venture funds obviously have different view towards valuation. So it's balancing and making sure everybody is aligned, because that can, at some point, I've seen it with some companies, become a big hurdle as they grow and they need more money, and they are divergent.
How do you find those family offices?
And those family offices,
like, how do you figure out so if you're an investment banker helping somebody raise money, you probably just have a set of relationships you go to.
Yeah, but there are always new investors, and there are investors who suddenly have an interest also because of private reasons. So I think, as a banker, I'm always on the look for great companies and on the look for investors, and it changes a lot. So it's constantly, looking. There are conferences, there are relationship connections.
I think, Roger, you've got it, just like Aidan said, network.
Yes.
Okay, your board should have some wealthy people on it, and your wealthy people know other wealthy people. generally. Unfortunately, that's the way we are in society. Okay, but then also get creative if you can't network. What is the area in which you're operating? What group of people are you helping? Find a wealthy person who might have a family member. Search the media, and make the one call. And if that call doesn't bear fruit, ask for introductions to other people. Like you just have to scrap.
Hustle.
As we all say, it's the warm introductions.
Yeah.
It's the warm introductions. One of the things I do is I always look at all the investors. You can go to PitchBook and you say, who's been investing? And so, they're interested in that space, this group here. If they're interested in that, they're probably interested in this.
Yeah.
And so things like that.
Yeah,
So
but again, use your board. If your board's not helping you, get a different board.
Yeah.
Thank you. I didn't mean to interrupt you, but that's why they're there. Okay?
Yeah.
Go ahead. Sorry.
Okay. Any last tips in 20 seconds or less for a group of people trying to raise money?
Good luck.
Yeah, work hard.
And
I think also, again, I can say this because I have dual citizenship. I would add an American or two to your management team, advisory board, or board. You had a very key technical co-founder who's American, incredibly
I
well
couldn't agree
respected,
more.
right? And I think a lot of these European companies are not adding Americans,
too late.
but you need somebody who can credibly sort of give comfort to investors that you can commercialize in the U.S.
yeah.
Yeah, I agree.
That's great. And that's interesting because that's our firm is built on being that bridge between, it's become the bridge between Europe and the U.S. Around investors, around people, talent. And it's like the ecosystem in Europe is thriving.
Yeah.
It's neat to see. It's really combined. I think it's all together in my world.
Yeah, and have a US strategy early on.
Yeah.
That's,
Okay.
that's
So thank you very much, guys.
Thank you.
Thank you, Roger.
Thank you.